Let me ask you something before we begin. Right now, at this exact moment, while you are watching this video on your phone or your laptop or your television screen, a transfer of wealth is happening. Not a small transfer, not a gradual, decade-long trickle. $17 trillion. Let me put that number in perspective for you, because a number that large stops meaning anything if you just say it out loud. The entire GDP of China, the second largest economy on the face of this earth, is approximately $17 trillion. The entire U.S. federal debt took over 200 years to reach $17 trillion. And right now, quietly, without press conferences, without headlines, without your financial advisor calling you to explain what is happening, $17 trillion is being redirected. Away from where it has always been, towards somewhere most Americans have never thought about. And the people who understand where it is going, they are positioning themselves to capture generational wealth. The people who don't, they will spend the next 20 years wondering why they feel poorer, even though they technically earned more. I am going to explain exactly what this shift is, why it is happening right now, who is orchestrating it, who benefits, who loses, and most importantly, what you can do about it before the window closes. Stay with me, because what I am about to show you will change the way you see every financial decision you make for the rest of your life. Before we go any further, I want to be completely transparent with you about something. The information in this video is not available on the front page of any newspaper. It is not what your financial advisor is telling you at your annual review. It is not what the anchors on CNBC are spending their broadcast time discussing. This is the kind of analysis that lives in the research departments of sovereign wealth funds, in the strategy memos of the world's largest asset managers, in the private client notes of institutions that manage more money than most countries will ever see. I am giving it to you today, at zero cost, in plain language. If you are not subscribed to this channel, do it right now. Hit that button, because what I cover here is not content, it is research, and the people who follow this channel consistently are not passive viewers. They are active, informed, financially aware individuals who make better decisions with their money because they understand what is actually happening in the world. Now, let's talk about the $17 trillion shift. The first thing you need to understand is what is actually moving. Between now and the year 2045, over the next 2 decades, the baby boomer generation, the single wealthiest generation in the history of the United States of America, will transfer approximately $84 trillion in assets to their children and grandchildren. Let me say that again so it lands properly. $84 trillion. In stocks, in real estate, in business equity, in retirement accounts, in life insurance payouts, in trust funds and family foundations. The single largest intergenerational transfer of wealth in the recorded history of human civilization. And the first major wave of that transfer, the initial $17 trillion, is already in motion, right now, today, as you watch this. Now here's where it gets important. Here is where the numbers stop being abstract and start being something that directly affects you, your family, your financial future, and the economy you will be living in for the next 30 years. The money is not going where people think it is going. Traditional financial planning assumed something very specific. It assumed that this wealth would flow down through families in a relatively linear way. Older generation passes, assets transfer to children, children invest those assets in the same instruments, the same markets, in the same geographic locations where that wealth was created. That is not what is happening. The recipients of this wealth transfer, primarily Millennials and Generation Z, are making fundamentally different decisions about where to deploy capital than any previous generation of American inheritors has ever made. And those different decisions are creating the shift. Let me show you what I mean with 4 specific, documented, verifiable behavioral differences. Difference number 1, real estate attitudes. Baby boomers built a significant portion of their wealth through real estate. Home ownership was not just a lifestyle choice, it was a financial strategy. Buy a home, watch it appreciate, use the equity, pass it down. Millennials, the primary recipients of this transfer, are the most rental-heavy generation in American history. Not because they cannot afford homes, that narrative is more complicated than the headlines suggest, but because they fundamentally do not assign the same financial and emotional value to fixed real estate ownership that their parents did. When you inherit money and your parents assumed you would buy property with it, but you don't buy property with it, where does the money go? That's the question driving the shift. Difference number 2, stock market relationships. Baby boomers largely trusted institutional Wall Street. They put money in mutual funds. They worked with brokers. They let Fidelity and Vanguard and Merrill Lynch manage their retirement portfolios in broad market index exposure. Millennials have a deeply fractured relationship with institutional finance. The 2008 financial crisis did something to an entire generation that cannot be undone. They watched their parents' retirement accounts get cut in half. They watched banks get bailed out while families got evicted. And the trust that was destroyed in 2008 has not been rebuilt. So when $17 trillion starts flowing through millennial hands, a meaningful percentage of it does not go into the S&P 500 index funds that supported stock market valuations for the past 40 years. It goes somewhere else. Difference number 3, geographic preferences. Baby boomers' wealth was concentrated in specific American cities: New York, Los Angeles, Chicago, San Francisco, Boston, the great coastal financial capitals that dominated the American economy for decades. The wealth transfer is funding a geographic redistribution at a scale that urban planners are only beginning to model. The Sun Belt is not growing because of climate preferences. It is growing because capital is moving there. When capital moves, infrastructure follows. When infrastructure follows, businesses follow. When businesses follow, jobs follow. When jobs follow, more capital follows. The cycle is self-reinforcing, and it has $17 trillion of jet fuel behind it. Difference number 4, asset class preferences. This is the one that will matter most to your personal financial decisions. Millennials and Gen Z inheritors are deploying capital into asset classes that did not meaningfully exist when their parents were building wealth. Private credit, venture equity, digital assets, alternative investments that used to require a minimum of $5 or $10 million to access are now accessible at $50,000, at $10,000, in some cases at $100. The democratization of alternative assets, combined with the largest wealth transfer in history, is creating capital flows into markets that most financial advisors are not tracking, not recommending, and in many cases do not understand. And when $17 trillion starts flowing through channels that traditional financial infrastructure was not built to handle, things change. Prices change, markets change, entire industries change. And the people who are positioned inside those changes before they fully develop, they capture the returns. The people who notice after it's obvious, they pay the prices that the early capital already drove up.
The second component of the $17 trillion shift is something that I want you to pay very close attention to because it is hiding in plain sight, and it is the single largest directed capital investment in American peacetime history. The United States government, through a combination of the Infrastructure Investment and Jobs Act, the CHIPS and Science Act, the Inflation Reduction Act, and associated state-level matching programs, has committed over $5 trillion to physical and digital infrastructure rebuilding over the next decade. Now, I know what you were thinking. You were thinking, okay, government spending, I've heard this before, doesn't usually change my life that much. You are about to understand why this time is structurally different and why the difference matters directly to your portfolio, your employment sector, and the value of where you live. Here is what makes this infrastructure cycle unlike any previous one in American history. It is not repairing what exists. Every previous major American infrastructure program, the New Deal, the interstate highway system, the rural electrification programs of the mid-century, those programs were building the infrastructure that the economy of that era required. This program is building the infrastructure for an economy that does not yet exist at scale. Let me be specific. The electrical grid that currently powers the United States was designed and substantially built between 1940 and 1980. It was designed for a specific load profile, households and businesses drawing steady, predictable amounts of power from centralized coal and natural gas generation. What is being built onto that grid right now? 50 million electric vehicles, each requiring regular charging at power levels that the existing residential grid was not engineered to handle. 2,000 new AI data centers, the massive computational facilities that run every large language model, every cloud computing operation, every streaming service, each consuming as much electricity as a mid-sized town. 300 new or expanded semiconductor fabrication facilities, which are among the most energy-intensive industrial operations that human civilization has ever created. The existing American electrical grid cannot support all of this simultaneously. It physically cannot. Goldman Sachs has published research indicating that by 2030, the United States faces a potential electricity supply shortfall of 40 gigawatts, the equivalent of the entire power generation capacity of several mid-sized countries. That shortfall is not a policy problem. It is not a political problem. It is a physics problem. And physics problems require capital to solve. Here's what that means in concrete terms for how money flows. The companies that manufacture electrical transformers, the large custom-built pieces of equipment that step voltage up and down across the transmission grid, have order backlogs stretching 3 to 5 years. Companies that build transmission lines, that manufacture copper wire at the industrial scale required for grid expansion, that engineer the specialized switchgear and protection systems that modern grids require, these companies are not waiting for the infrastructure spending to arrive. The orders are already placed. The contracts are already signed. The revenue is already booked multiple years into the future. And most retail investors have no idea this is happening because none of it is covered in the financial press with the intensity that Apple earnings or Fed rate decisions receive. Now let me tell you about the second invisible infrastructure bet, and this one is even more important because it is not about physical infrastructure at all. It is about water. The American West is running out of water. This is not an environmental talking point. This is an engineering and economic reality that municipal planners, agricultural economists, and real estate developers in 17 states are actively planning around right now. Lake Mead, the largest reservoir in the United States, which supplies water to Las Vegas, Phoenix, and the agricultural regions of the Southwest, has been at historically low levels. The Colorado River Compact, the century-old agreement that governs water rights across 7 western states, is being renegotiated because the underlying water supply assumptions it was built on no longer reflect physical reality. Water scarcity in the American West is not a future problem. It is a current problem with a compounding trajectory. And where capital flows to solve the water problem, desalination technology, water recycling infrastructure, pipeline systems, agricultural efficiency technology, is where significant returns will be generated in the next decade. This is not speculative. Israel has been running a water-scarce economy for decades and has become the world leader in desalination and agricultural water efficiency technology. The companies that built that expertise are now positioned to sell it to the American Southwest at a scale and price point that the market has never seen before. The $17 trillion shift is not just about inheritance. It is not just about demographic change. It is about capital being directed, both by private inheritors and by the federal government, towards rebuilding an American economy for a set of conditions that are fundamentally different from the conditions the previous century of prosperity was built on. The people who understand which sectors sit at the intersection of all those capital flows, they are not watching the markets everyone else is watching. The third component of the $17 trillion shift is the one that I want you to sit with the longest, because this one is the most consequential, the most misunderstood, and in many ways, the most invisible. It is about the US dollar, and specifically, it is about a quiet, gradual, accelerating process that the financial press has been reluctant to discuss with the clarity that it deserves. Let me start with a number. In 2001, the US dollar represented approximately 73% of global foreign exchange reserves. Every central bank in the world, the Bank of China, the European Central Bank, the Reserve Bank of India, the Bank of Japan, they held their reserves in US dollars. They bought US Treasury bonds. They kept their national savings accounts denominated in American currency. The reason for this is historical and practical. After the Second World War, the United States emerged as the dominant economic and military power on Earth. The Bretton Woods Agreement made the dollar the world's reserve currency. Oil was priced in dollars. International trade was settled in dollars. If you wanted to buy things in the global economy, you needed dollars. That arrangement gave the United States something extraordinary, something called exorbitant privilege. Because everyone needed dollars, the U.S. government could borrow money more cheaply than any other government on Earth. It could run trade deficits without immediately facing currency crises. It could finance its military, its social programs, its infrastructure, all at interest rates that no other nation could access. That privilege has been the silent, structural subsidy of American prosperity for 80 years. Now look at that same number today. The US dollar share of global foreign exchange reserves has declined to approximately 58%. 15 percentage points in 2 decades. 15 percentage points of what used to be mandatory global dollar demand has shifted to other currencies, to gold, to bilateral trade arrangements that deliberately bypass the dollar-based system. Now let me tell you why this is accelerating right now at this specific moment in history. The weaponization of the US dollar following Russia's invasion of Ukraine, where the United States and its allies froze approximately $300 billion in Russian central bank reserves held in Western financial institutions, sent a message to every central bank in the world that was not aligned with American foreign policy. The message was this: your dollar reserves are not unconditionally yours. China heard that message. Saudi Arabia heard it. India heard it. Brazil heard it. Every nation that has any ambiguity in its relationship with the United States heard it. And in the 2 years following that decision, the rate of central bank gold purchases reached the highest level ever recorded. Not the highest since 2008, not the highest since Bretton Woods, the highest ever recorded in the history of central banking. Central banks do not buy gold for speculative reasons. They buy gold as a reserve asset when they are reducing their confidence in paper currency alternatives. The dollar is not collapsing. I want to be very precise here because precision matters enormously on this topic. The dollar is not collapsing. It remains the dominant reserve currency. It will likely remain the dominant reserve currency for years, possibly decades. But dominant and unchallenged are two different things. And a dollar that must compete for reserve status, even marginally, even partially, is a dollar that must offer something in return for that status: a higher interest rate, more favorable trade terms, reduced sanctions risk. Every single one of those adjustments has a cost that eventually flows through to the American consumer, the American taxpayer, and the American investor. The alligator jaws of reserve currency work exactly like the alligator jaws of the bond market that the viral Bank of America report described. The upper jaw is American financial confidence, the stock market, the consumer spending numbers, the GDP figures that make everything look strong. The lower jaw is the structural erosion of the dollar's privileged position, quiet, slow, but measurable and accelerating. Those jaws always close. The only question that matters for your financial positioning is whether you are inside the jaws when they do, or whether you are positioned outside them.
Everything I have shown you in the past 20 minutes is real. It is documented. It is verifiable. And I have delivered it to you with full source attribution because I do not traffic in speculation or fear-mongering.
But knowledge without action is, and I mean this literally, the most expensive hobby in the world. So now I am going to give you the framework, the specific 4-step analytical system for identifying where inside this $17 trillion shift your capital can work hardest. Filter 1. Follow the mandated capital. Not all capital flows are created equal. Some flows are speculative. They go where sentiment goes, and they leave when sentiment changes. Mandated capital is different. Mandated capital is money that must flow somewhere regardless of market conditions, regardless of sentiment, regardless of who wins the next election. Infrastructure bond money is mandated capital. It is appropriated, it is allocated, it is contracted. It flows to specific sectors, specific geographies, specific companies, and it flows whether markets are up or whether markets are down. The first filter asks a simple question. Is this sector or company in the direct path of capital that has already been committed? Electrical grid infrastructure? Yes. Water treatment and recycling technology? Yes. Domestic semiconductor manufacturing? Yes. AI data center energy infrastructure? Yes. These are not bets on the future. They are positions inside contracts that are already signed. Filter 2. Identify the demographic tailwind. The $17 trillion wealth transfer is not neutral. It does not flow evenly. It flows disproportionately toward the preferences, habits, and consumption patterns of the generation receiving it. Every product, every service, every asset class that Millennials and Gen Z disproportionately prefer over their parents' preferences is in the path of a sustained, multi-decade demand increase. Experiences over possessions, travel, dining, live events, structural growth. Digital financial infrastructure, payment systems, private credit platforms, alternative investment access, structural growth. Health optimization, not just sick care, preventive medicine, longevity research, fitness, structural growth. Rental housing in Sunbelt metros, structural growth. The second filter asks, am I positioned where the largest wealth transfer in history is directing spending? Filter 3, the hard asset hedge. In an environment where the dollar's reserve status is gradually eroding, where inflation is demonstrated that it can spike above the comfortable ranges that financial models were calibrated to, assets with intrinsic physical value perform a specific function in a portfolio, not as speculation, as insurance. Physical commodities that the energy transition requires, copper, lithium, rare earth elements, these are not optional inputs. Every electric vehicle requires 60 to 80 kilograms of copper. Every offshore wind turbine requires several tons of it. The energy transition is a copper supercycle, and copper comes out of the ground. You cannot print it. Gold at the portfolio level, not as a speculative trade, but as the same asset that the world's central banks are buying at record levels when they reduce dollar exposure. If the most sophisticated institutional actors on Earth are buying gold as a hedge against dollar erosion, retail investors who ignore that signal are making a very specific choice. The third filter asks, do I have meaningful exposure to assets that hold value independent of paper currency confidence? The fourth filter is the compounding geographic bet. The Sunbelt population migration is not a trend. It is a structural realignment that is early in its development and decades from completion. When population grows, several things grow mechanically with it. Tax revenues, infrastructure investment, commercial real estate demand, healthcare demand, educational institution expansion, retail spending, local banking assets. The cities that are capturing the $17 trillion shift, Austin, Nashville, Phoenix, Charlotte, Tampa, Raleigh, these cities are in the early stages of the same structural growth arc that transformed the coastal metros from 1970 to 2000. The fourth filter asks, am I positioned in the geographies where the next 30 years of American economic growth will be disproportionately concentrated?
I am going to give you 5 specific practical steps that you can execute this week. Not theoretical, not vague, specific. Step 1. Audit your current portfolio for shift exposure. Pull up your current investment accounts, your 401k, your brokerage account, your IRA, and ask yourself this question honestly. How much of this portfolio is positioned for the economy that existed from 1990 to 2020, and how much is positioned for the economy that will exist from 2025 to 2045? If you hold a broad S&P 500 index fund, and there is nothing wrong with holding one, understand what you are holding. The S&P 500 is heavily weighted toward technology companies and financial companies that were built for the old economy. It is not structurally positioned for grid infrastructure, water technology, or Sunbelt geographic growth. Step 2. Build your mandated capital watch list. Identify the 3 to 5 publicly traded companies that sit most directly in the path of already committed infrastructure capital. Power grid equipment manufacturers, electrical engineering firms, water infrastructure specialists, domestic copper producers. Write those names down. Set price alerts at levels 25% and 40% below their current price. You are not buying today. You are preparing to buy opportunistically when broader market corrections create entry points. Step 3. Establish your hard asset baseline. If you currently hold zero physical commodity exposure, no gold, no copper producers, no energy transition metals, you are making a directional bet against what the world's central banks are doing with their reserves. I am not suggesting you move your entire portfolio into commodities. I am suggesting that zero is likely the wrong number, and that establishing a baseline allocation of 5 to 10% of investable assets in hard asset exposure is a defensible, evidence-based decision in this specific macroeconomic environment. Step 4. Research the Sunbelt real estate market closest to your situation. You do not need to move, you do not need to buy physical property, but understanding the cap rates, the population growth trajectories, and the infrastructure investment profiles of the 2 or 3 Sunbelt metros with the strongest structural tailwinds gives you the analytical foundation to evaluate real estate investment trusts, regional banking exposure, and infrastructure company geographic concentrations with a level of specificity that generic national analysis cannot provide. Step 5. Mark the next 18 months in your calendar as the positioning window. The $17 trillion shift is real, documented, and in motion, but capital movements of this magnitude do not create their full market impact overnight. They develop over years. And within multi-year structural shifts, there are always compression events, market corrections, geopolitical shocks, policy changes that create entry points for prepared investors to position themselves inside the shift at prices that will look extraordinary in 10 years. The next 18 months contains several of those potential compression events. Federal Reserve policy uncertainty, the full landing of the commercial real estate correction, geopolitical flashpoints that create commodity price volatility. These are not threats. They are opportunities, but only for investors who have done the work before the compression arrives. I want to leave you with something that goes beyond the numbers. Over the past 30 minutes, I have shown you 3 converging forces: the largest intergenerational wealth transfer in human history, the largest directed infrastructure investment in American peacetime history, and the quiet but measurable erosion of the dollar's unchallenged global dominance that are simultaneously reshaping where wealth is created, where it is stored, and who captures it. This is not doom. I want to be clear about that. This is not a story about America declining. It is a story about America changing. And change, structural, directional, multi-decade change, is the single most reliable creator of investment opportunity that exists in financial markets. Every major structural shift in the American economy over the past century created fortunes for the people who understood it early. The electrification of rural America in the 1930s created fortunes. The interstate highway system created fortunes for real estate developers, logistics companies, and suburban home builders who positioned early. The personal computer revolution created fortunes. The internet created fortunes. The smartphone created fortunes. Every single one of those shifts looked chaotic and uncertain in the middle of it. Every single one of them rewarded the people who had done the work to understand where the capital was flowing before it became obvious.
Right now, at this moment, you are watching a video that a very small percentage of investors will ever see. Not because it's hidden, because most people choose the comfort of the familiar over the discomfort of preparing for what is actually coming. The $17 trillion shift is not waiting for you to be ready. It is not pausing while you decide whether to take this seriously. It is not going to announce itself on the front page of the newspaper before the best opportunities have already closed. It is happening right now. Quietly, structurally, irreversibly. There are two types of people who watch this video today. The ones who will take the framework I have given them, build their watch list this week, audit their portfolio this weekend, and begin positioning themselves inside the greatest structural wealth transfer of their lifetime. And the ones who will close this tab, go back to their day, and meet me in the comments 5 years from now saying they knew, and they didn't act. I know which one you are. You know which one you are. Subscribe, build your list, prepare. And before you go, drop a comment right now. Which of the 4 sectors, infrastructure, demographics, hard assets, or Sunbelt real estate, do you think will generate the biggest returns over the next decade? I read every comment. Tell me where you are positioning. Subscribe, hit the bell, and I'll see you in the next one.